Okay, so when a major oil dictator gets captured, you'd expect markets to absolutely panic, right? Oil prices should have skyrocketed, maybe towards $100 a barrel. But when U.S. forces captured Nicolás Maduro, Brent crude barely flinched. The number you're looking at is where the price settled. And that number, well, it tells a story that's way more complicated than any headline you're going to read. It's because the market isn't reacting to some political arrest. No, it's reacting to what's essentially a hostile takeover of the world's largest oil patch. And while all the news is talking about liberation, the data, well, the data reveals a bunch of logistical, financial, and security time bombs just waiting to go off. All right, let's get into it. We're going to break this all down into 6 key themes to really unpack what's going on. We'll start with the mystery of that $61 price tag, then get into the physical, financial, and security crises it's kicking off, the huge bill that's coming due, and finally, what this all really means for U.S. policy moving forward. Right. So, while the rest of the world was glued to their screens watching this dramatic capture of a dictator, the people whose job it is to actually move and trade oil, they were looking at a totally different set of facts. They saw this wasn't the start of some new oil boom. It was the beginning of a massive geopolitical mess. And to really understand the market's strange calm, you first have to get your head around the really unique and pretty problematic nature of Venezuelan oil itself. That's the first big piece of this puzzle. Exactly. Most people hear that Venezuela has over 300 billion barrels of oil reserves. I mean, the largest on the entire planet. And they just imagine this flood of crude about to hit the market. But that idea, it's completely, totally wrong. And here's the reason why. Venezuela's oil isn't that light, sweet crude that just flows out of a well. It's extra heavy crude. So I want you to think less like a liquid and more like, well, asphalt or cold molasses. It's this thick, viscous sludge that you can't just pump through a pipeline. This really puts it into perspective, doesn't it? U.S. shale oil is light. It flows. Venezuelan crude is basically sludge. To get it to move at all, you have to mix it with a special thinning agent, a chemical called a diluent. If you don't have that, the oil is basically useless. It's just stuck. And this brings us to the logistical deadlock. See, under Maduro, Venezuela was getting these absolutely critical diluents from Russia and Iran. But now, with a full-on U.S. blockade in effect, that supply line is completely gone. So even if American companies wanted to restart the pumps tomorrow, they're missing the chemical key to actually move the oil anywhere. The storage tanks are just filling up with totally untransportable sludge, which creates this unbelievable paradox. Look at this. The stock prices for energy giants like Chevron and SLB jumped because investors got excited, but in reality, they can't access the oil. And here's the real kicker. If they did somehow flood the market with this heavy crude, it could paradoxically crash the prices for U.S. shale producers. It is a logistical nightmare that could actually undermine U.S. energy dominance from the inside out. So the oil is physically stuck. But while the actual crude is going absolutely nowhere, the money is moving at lightning speed. Wall Street is in a complete frenzy, which brings us to our next major theme, the crazy financial paradox that's brewing. And you can see that frenzy right here. The second Maduro was captured, the price of defaulted Venezuelan government bonds just exploded. They jumped from 16 cents on the dollar to over 42 cents. Bond traders are making a huge bet that a new U.S.-backed government is finally going to pay off the country's massive defaulted debts. And the size of that debt is just staggering, $150 billion. That's what bondholders are lining up to collect. But they're about to run smack into a very, very big problem. And yeah, that problem is President Trump. He has been crystal clear about this. Before any bondholders get a dime, before any foreign creditors see a penny, the U.S. taxpayer is first in line to get reimbursed for the cost of the entire operation. This is setting up an absolutely epic collision course. So you've got 3 major players all fighting for the exact same pile of oil money. You've got the international bondholders, you've got China, who's owed tens of billions in loans, and you've got the U.S. government. This all brings up the Pottery Barn principle in international law. If you break it, you own it. By essentially running Venezuela, the U.S. could become legally on the hook for its debts. It's a sovereign debt trap, totally disguised as a reconstruction rally. So we have a logistical mess and a financial collision. But the whole intervention was sold as a move to stabilize the region. In reality, it may have done the exact opposite. Let's take a look at the security fallout. The power vacuum in Caracas has had an immediate and very dangerous effect. These violent criminal syndicates, they're known locally as sistemas. They controlled illegal mining and smuggling. Well, now they're being pushed out, and they're flooding across the border into neighboring Guyana, which just happens to be home to one of the world's biggest new oil discoveries, operated by ExxonMobil. The chaos isn't being contained, it's being exported like a regional wildfire. And you can see the real, tangible cost of this instability right here. War risk insurance premiums for any ship operating near Guyana and Trinidad have spiked over 200%. Instead of securing a vital energy corridor, the intervention has basically turned it into a contested zone, making everything more dangerous and more expensive for everyone involved. Okay, so let's just imagine for a second that the US somehow solves the diluent deadlock, and the debt paradox, and the security contagion. That still leaves the biggest question of all. Can they actually fix Venezuela's totally collapsed oil industry, and what's it going to cost? The energy analysis firm Rystad Energy put a number on it. Just to get Venezuela's production back to where it was in the 1990s, that would require an investment of $110 billion over the next decade. This is a monumental, massive undertaking. And so far, the major U.S. oil companies have been completely silent. And here is the core reason they're so quiet. I mean, think about it. No company is going to pour billions of dollars into a country when its legal head of state is sitting in a jail cell in New York and the acting president, Delcy Rodriguez, is walking this incredibly thin tightrope. There's just zero legal certainty about who truly owns the assets or who can even sign a binding contract. The whole project is paralyzed by political risk. So when you zoom out from all these logistical, financial, and security problems, you start to see the much, much bigger picture. This isn't just about one country or one dictator. This event really marks a fundamental shift in American foreign policy. People are starting to call it the Donroe Doctrine, a kind of modern twist on the old Monroe Doctrine. The U.S. is no longer just a superpower trying to exert influence. It's asserting the right to be a de facto administrator of a whole nation just to secure resources and its own interests. We're talking a move from coercion to direct control. And what all this means is that the capture of Maduro, that wasn't the end of a crisis. Not at all. It was the beginning of one. It was the opening of a massive ledger with debt, reconstruction costs, and security liabilities that could easily top $300 billion. Which leaves us with the final big question. Was this a historic victory for American foreign policy? Or is it the start of the most expensive and complicated geopolitical victory in American history? Because right now, the oil is stuck, the creditors are circling, and everyone is just waiting to see who is ultimately going to pay the bill.